Yo, yo, yo. Hey, I'm Mark Buckner with the Mark Buckner Group at Compass, and I'm here with my preferred lender, Ben, from Molitor Financial. And we're going to talk a little bit finance today. Ben's blessed us with some time, which I am very appreciative.
Of course.
And we are at the Content Club. Big shout out to them and the BLT, Ben Lala's team, for allowing us. And if you're looking for a place to cut some good content, it's here. This place is dope. So hook up with Ben. Be sure to tell him I referred you, Mark Buckner referred you to the Content Club. All right, Ben, let's get into this.
Let's do it.
Talk lending.
Yep.
So one question I have for you. You work at Molitor, boutique, mortgage, brokerage. What's the benefit of, what's the pros and cons of going with a small boutique versus why aren't I going to Chase or Wintrust or BMO? You know, what do you have to offer that's different?
I think that the biggest difference between, say, a boutique brokerage versus, walking into BOA or Chase is options, right? So working in a mortgage brokerage means that I am working with 15, 20 different lenders, and that means that all of the products that they offer, we can offer. So if you need some sort of a niche type program for maybe a condo that has some issues with the HOA, or you're just looking for a standard conventional mortgage, well, now we have 20 people to price out against each other.
So, I don't understand. What do you mean you have 20 different lenders? I thought you were a lender.
No, I am not. So the term broker really just means that I am going out and looking for lending relationships with different banks, credit unions, wholesalers. Our company then signs them up, right? And we are able to essentially find and originate the loan, bring it to them, and then do that loan through whoever that lender is.
So why would somebody offer something different, right where I'm just trying to get a mortgage? What's the difference? What's something different that one lender would offer than somebody else?
So the easiest difference is rates.
It's all green, right?
Yeah, that is true. The easiest difference is rates. So each lender releases their own rate sheet every single day, and they get to choose how the pricing shows on that rate sheet, right? So for instance, there's a wholesaler right now out of Michigan called Next Bank. They're blowing everybody out of the water right now because they are trying to get market share in our current climate and get as many loans in as possible, whereas some of the other old faithful lenders, Quicken Loans is one, or Rocket Mortgage, right? Some of the other bigger wholesalers, they're not really in the game compared to them. So the nice part about being a broker is I get to see all of these differences in pricing, and then I can take my client to get them the best deal.
Wait a minute. So someone can offer a cheaper rate than somebody else? I thought the feds make the rates.
No, not at all. So the Federal Reserve sets their rate, which is called prime. That's another name for it. And their rate directly impacts things like credit card rates, car loans, home equity lines of credit. Does not impact mortgage rates at all. Mortgages are controlled by mortgage-backed securities. It's a type of bond, right? So every day this bond is bought and sold, just kind of like a stock, and the value of that bond goes up and down depending on demand. So because of that, these lenders are selling the mortgages that they fund on the secondary market, usually to Fannie Mae or Freddie Mac, and they're basing it off of the bond price at that time, right? So there's actually substantive differences between different lenders on what they're trying to get in the door because they think they can get a good deal when they sell it to one of the big agencies afterwards.
So you're saying the lenders then take that money, sell it off as a bond that people can buy, but some lenders are selling it for a higher interest rate or a lower interest rate. Yep. And so the wholesaler that you talked about who's doing a ton of it, he's offering or she's offering a better deal for that investor, so they're moving more money.
Exactly right, yes.
So how do they get to move more money than somebody else?
It's all depending on kind of the demand for a certain bond coupon, right? So for instance, this bank that I'm talking about, or wholesaler, Next Bank, they are really, really trying to move 30-year fixed rate conventional mortgages, okay? But if I went and I looked at a 20-year or a 15-year fixed rate conventional mortgage with them, garbage. absolute garbage. They're not good at all, not competitive. So they're trying to get this certain type of mortgage in the door because they think that they can package a bunch of those up and sell them at a profit afterwards.
Got it.
Yeah.
So we've gone into the weeds with this.
We really did. That was
Pretty
quick.
quick.
Jumped into the deep
Pretty
end.
quick. But the thing that I think that I like personally about a boutique versus a big lending institution is one is you can go to many different lenders, right? So, Chase sometimes are just funding their own loans.
Most
So
certainly they are.
have
Yep.
less options than you do. And for me, I kind of always interpreted as like you can live in more of a gray area than other people. Not that
Most certainly can.
not that it's not more people more than bigger financial institutions because they're going to have their corporate rules and this is how we do business, and it's a little bit more black and white where you can just, if there's not this option or that option. The other thing that I think I really like, and I think why I really connected, and I share this with my clients, you may not even know this. I know I can call you, if I need a pre-approval letter on Christmas morning, I know I can call you. I won't do it, but I know if I have to, you're gonna pick up the phone for me.
Yeah, I can't help myself. I have to.
No one at Chase is picking up the phone for me on Christmas morning or Christmas Eve morning or New Year's Day.
Yeah.
No one's doing that. And, I think when I first met you, and I say this, lots of lenders are, I tell you this all the time, lenders are always calling, courting, of
course,
right?
yeah.
And, I tell everybody, when are deals done?
When they fund.
No, but when are deals put together? When
I
do I
gotcha.
usually call you for a letter?
Not during normal business hours.
No, it's not Tuesday at 10 o'clock?
No.
No?
Yeah, it is. 10 p.m.
Yeah. Or Saturday at 10 p.m.
Exactly
or
right.
Sunday at 7 a.m. I think this Sunday was about a 7
I'm pretty
a.m.
sure you
call.
did, yeah.
Yeah, that's probably the other thing that I really like. And you get to, I think, difference than a big financial institution, you're able to develop a relationship with that lender and not just calling out hours because, we joke, but that's how deals really are put
is.
together.
Yeah.
Over the weekends, at all odd times over the weekends, that's when they're put together more times than not. Then the other topic that I want to talk about is not just rates, is fees.
Okay, sure.
And how do fees work? Because I often always heard like Fed set the rates, but the fees are really where the nitty gritty is at, and you want to know what you're paying there. And how do you guys differentiate, or who gets charged what on these fees? Like, how's that? How do you get paid?
Yeah, okay, all right. So a decent amount of questions in there. So first question is about fees and closing costs, right? I think easier way. I differentiate closing costs in a couple of different ways. So you have your actual lender fees, right? That are who you're working with, what they're charging you to get this loan done. Yeah. And then you have other closing costs that kind of are going to be the same no matter what. Your title fees, you're going to have insurance and got to pay the city of Chicago, right? That kind of stuff, or whatever municipality you're in. The thing that I find, and I actually say this to all of my clients when we're going through a fee worksheet, is that the delta for lender fees, right?
Delta, you just geeked out and brought in some new term that I don't even know about.
So the difference between most expensive and least expensive for lenders, it's like $300 difference between the most expensive underwriting fee that a lender charges and the least expensive.
So $300 difference. Mm-hmm. But what's the high and low range typically?
So the high that I see right now is $11.95 is the high for a lender's fee, right? The low is $920-ish. $920 is the lowest that I see right now. So what I'm trying to kind of get across is that there's really not that big of a difference in the actual closing costs anymore because everybody's really shored up to be pretty close to each other. So that's why I end up really just going back to being hey guys, it's really about rate. It's about rate because that's where we're going to save money over time, which if I lose $200 on an underwriting fee, but I can get a 0.25% better interest rate, who cares?
So are you often then getting courted by other vendors
Yes.
that are
yes,
which would be different than if I was at BMO, Chase. So you're in so many words you're saying I can get a better deal. In summary, maybe you're not directly saying this, but in summary I can get a better deal from more of a boutique mortgage broker, and I find I get better service.
Yeah, the service aspect is definitely different with kind of a smaller company like ours. because I'm the person that you're with the whole time, right? So at some of the larger places, no matter if it's a bank or a correspondent lender, they really kind of try to put the loan officer in a place where they don't have to actually do the business. They just have to go out and like get it, right? If that makes sense.
Yep.
So when the client is finally in the door and they're under contract on a place, the loan officer's gone. Now you're with their processor or their loan officer assistant, and you're getting passed back and forth between people, and the person that you thought you were working with up front, well, they're on to the next. And what I have found, at least in my business, that has created a much more long-term sustainable business is form the relationship, stay with them the whole time. Because then they know they have this go-to person. They can call me whenever, we already established that.
Yep.
And afterwards, the relationship continues, and it wasn't just a transaction. And I'll have somebody call me 4 years later, and when I pick up the phone, I'm like, oh, hey, yeah, of course I remember you. What's going on? How can I help? And maybe it's a silly question about the tax bill that they got or something like that. What a great way to stay in communication and develop long-lasting relationships, which in our business, they turn into other referrals, right?
Yeah.
And I think that's a really great way to form this kind of rock rolling down the hill, right? In terms of business, that it builds on itself.
Sure.
Yeah.
Sure. Jeremy, behind the camera, the star, the true star, brought up 2-for-1 buy down.
Yes. Yeah.
You and I, when this first came out, had a lot of phone calls about
We
it
did.
because I couldn't wrap my head around it.
It took me a second too, though. It's okay.
Didn't
You're in
make
good
sense to
company.
me. So give me the breakdown. What's the 2-for-1? Is it a deal or is it not a deal?
Okay, so maybe a controversial opinion here. I do not think it is a deal at all. I think it is a shell game of moving money in different places and coming out to actually something that ends up costing you a little bit more. So let me back it up a little bit.
Yep.
Okay, so a 2-1 buy down is when you're temporarily lowering your air quotes interest rate by a certain percentage for a certain amount of time. So in a 2-1, the first year, that interest rate is lowered by 2%. In the second year, it's lowered by 1%. And then for the remaining 28 years of the mortgage, it's back to whatever you locked in originally.
So let's use round numbers. I bought in, rate you quoted me was 7%. So the first year I'm at 5.
Yep.
Year 2, I'm at 6. Year 3 to year 30, I'm back at 7.
You got it. Now, the way that you accomplish this buy down is really where the meat and potatoes is of why I don't like it. So in order to accomplish this buy down, you generally have to do one of two things. You have to either get a credit, a seller credit, right, from whoever's selling you the property to cover the cost of this temporary buy down, because there is an upfront cost to it, right? Okay.
Hence buy.
Exactly. So this money that you use to buy this interest rate down, well, the thing is, it's just a subsidy. Your rate, it's never being lowered. You're not actually getting a lower rate when you start that mortgage. What they're doing is they're taking that money that the seller paid for you to do that buy down, and every single month, they're taking a little bit out of it to subsidize your monthly payment. You've gotten no benefit from actually having a lower interest rate because your interest rate was 7% the whole time. They were just subsidizing the monthly payment to make it look like it was if you had the interest rate of 5%.
So in other words, I'm saving some money if the seller gives me the money to do it.
Well, I would argue if the seller's going to give you that money, why don't we look at a permanent buy down instead, where you're actually saving money?
What does that look like?
So one of the options for when you're getting a mortgage, and this is not anything new, is that when we price out a rate, let's use easy numbers again, right? Say I'm saying, hey, 7% is the rate that you could get today. The next question that somebody could ask is like, okay, well, what if I wanted to pay an extra fee to buy that interest rate down for good for 30 years? That's always an option. It's called paying points. And maybe instead of taking...
What'd you call it?
Paying points.
Paying points.
Yep. And maybe instead of using that money for the temporary buy down or monthly payment subsidy, we take that and actually lower the interest rate by whatever that money can buy us, and then it's lower forever.
So let's use examples. $500,000 purchase, I'm quoted at 7, I'm gonna buy a point down. What does it cost me to buy the point?
Well, that depends. So it's a little bit more complicated than that. Because if you're going to buy a point down, right? So that means that
Pay it down, as you said. Pay
so that means
the
you're
point
paying 1% of the loan amount, right, as a fee. That's what 1 point is. And that may get you somewhere around maybe 0.5% lower on the interest rate. So maybe now instead of 7, you're at 6.5%, and you were truly at 6.5%, right? The rate is actually there. The reason this stuff matters, and this is getting very into the weeds, is that when we actually look at the amortization schedule of that mortgage payment, right? When you have a lower rate, an actual lower rate, number one, you're paying your principal off a little bit quicker up front, and you're actually saving interest. On the 2-1 buy down, you were at 7% the whole time. You were paying interest on a 7% mortgage. They're just giving you a little money out of that pool to make it feel like your monthly payment was lower.
So for the 2 years that I thought I was really saving money, someone's just giving me money, the interest rate is still on 7% versus
Bingo.
But what's it kind of looking like if I'm doing a 2-for-1 buy down versus buying a 0.5 point?
In terms of like
The actual money.
money
Like,
savings.
What's it costing me, right? The seller's giving me a credit, I don't know, 10,000,
Sure.
20,000,
Yeah.
I don't know. And what's it costing me for that 0.5 point? Just ballpark, if it is possible to kind of ballpark that.
It's a little hard to ballpark in terms of those numbers because, you know, the details of like what's the loan amount size, what does that actually equate to monthly?
We're using 500,000, 80% loan to value, so
So for 500,000, 80% loan to value, $400,000 loan, every 0.1% is going to be roughly $40-ish in your monthly payment. So if you're, say, taking it down 0.5%, right, then that means that that's roughly $160 monthly savings, right? If you're looking at that 2-1 buy down,
the savings 160, so is that 160 then times
however long you hold the place.
30 years, and that's how I got to pay it up front?
Well, that's if you're buying down the rate permanently, that savings is permanent. So you're saving that every month for the term of your mortgage.
But what did the point cost me, though?
Well, it would be 1% of your loan amount. So in this situation, $4,000, right, is 1% of the loan amount. So if we're starting with a rate of 7% and that rate's not costing you anything, right? That's your par rate, just what you get if you want a rate. And then if you're saying, hey, I want to buy that rate down by a full point, right? That means that you go, I was actually pretty much spot on. You go from 7 to 6.5%, right? So then the question is, okay, what am I actually saving on a monthly basis by doing that, right? So on this loan, it ends up being, just about $160 a month. All right, we're doing good so far.
Right,
so
we're at
far,
56,000.
Yeah, so far those are good. So then if I'm paying $4,000 to do that, and I divide it by my monthly savings of $160, right? That means that I'm going to break even on that in 2 years. I made my $4,000 back. If I do a 2-1 buy down, I didn't save shit. I didn't save anything, sorry.
But we don't know what the 2-for-1 buy down costs you.
Yeah, so I can tell you what the 2-for-1
or whatever
does.
it costs that seller, whatever you credit. Are you getting 4K? Are you getting?
So I can actually tell you that as well, just by looking at these numbers. So a 2-1 buy down. So let's do 7% in this situation. So the way that they do the 2-1 buy down is it's literally just the difference in monthly payment for the first year versus the 7%, add all that up, and then the difference in monthly payment between the second year and 7%, add it up, that's how much it's gonna cost you. It's a very simple calculation. And I bet you it ends up being way more than $4,000 is what it would cost. We'll see. Because then you have way more money to buy that rate down, right? Permanently versus doing the temporary. You see where I'm going with this? $9,345. So in terms of points, right? You're talking about 2.3%. So my whole calculation of going down to 6.5%, not even close. You'd go down so much more by spending all of that money on a permanent buy down.
So let me kind of summarize what we're talking about here and kind of wrap this up. And so we were talking about 2-for-1 buy down, right? Typically the way that's done, Ben, you can chime in, correct me if I'm wrong, is I could either ask the seller to give me a credit for that, 2-for-1 buy down, which means they're buying me 2 points the first year, 1 point the second year, but I'm still charged at that 7%. So if I got a loan, $500,000, I financed 80% loan to value, that's $400,000. You quoted me 7%. Seller can give me a credit, which averages about, for the 2-for-1 on that type of loan, we talked about, I'm rounding up, about $10,000.
Yep.
And so what that gives me is basically extra money for the first year to pay the extra 2.5 point savings that I had, in the second year, 1%, because no matter what, I'm still charged at 7%.
You
right?
got it.
But I can do a pay down, which means I'm buying a 0.5 point down.
So you could do a permanent buy down.
Yep,
instead.
permanent buy down. So instead of being at 7, I'm at 6.5 over 30 years.
So actually, it's more like 6%. You'd be buying down a full percent with that same amount. If you're spending 10 grand.
If I spent the 10 grand.
Yeah.
If I spent the 10 grand. If I just did 4 grand, I can buy down a 0.5 point, which in the end is about a savings of 160 per month times 12 for 1 year, times 30 for 30 years.
Yep.
Jeremy did the math for us. That comes out to be about $56,000 that you're savings. So really big, huge difference. And correct me if I'm wrong, and the way I see most people doing the buy down is that I'm paying that house for $500,000, but I'm asking for a $10,000 credit from the seller. So I'm actually, the contract price is now $510 because the seller's not going to give me that money, right?
Yes.
They're going to let you raise that contract price. So you're spending an extra 10 when you really could just spend 4 and get a 0.5 point and a much larger savings.
Yep.
So this is why this was such a mind boggle.
It was hard to figure out at first. It really was.
And it didn't really, I say we figured it out. Ben figured it out because you do it and did the math long run on a spreadsheet for us. So we're talking about rates. I got one last question for you.
Okay.
Everybody wants to know, where's the rates going? October, we capped out at 8%.
Oh,
Yeah. We saw the market. They have gone down.
Yeah, I mean, call it
bit.
roughly 6.5 to 6.625 right now.
Yeah.
Yeah. So they've come down by almost 1.5 points.
So we are in an election year.
Yes.
Going to be a roller coaster, especially fourth quarter with how the battle of the election goes out. What do we see? What do you typically see during an election year? And then what do you think? I mean, where's this whole inflation stuff? What's your prediction? Lay it out there, man. Don't be afraid, Ben. We're just under camera. We're going to hold you accountable.
Got it. Okay, perfect. Everybody will see it forever. If I'm wrong, I'll be shamed forever. Yep.
No stories. This will be in social media.
Let me pull my crystal ball out.
Yeah.
So I have predictions, but whenever I talk to clients, I always say, like, I'm just one idiot prophesizing here, right? Like, that's really what I am.
Yeah.
Because there's a lot of us out here trying to essentially tell the future of what we think is going to happen. And my current sentiment is that inflation, for the most part, has dramatically declined, right? From like the 7, 8, 9% numbers we were seeing at the latter half of COVID down to now like mid to low 3s on some of these reports, especially the core consumer pricing index. So that is good, right? And what's going to happen from here, and what's already been signaled, is that the Federal Reserve is halting, right? They have stopped raising their rate. And now I think the New York Times just a couple of weeks ago came out and said they're predicting 4 rate actually cuts this year. So we have a Fed meeting in March, and then in May. I think that the March one right now, pretty low probability, but the May one, we might see our first cut in rates in May.
So we could see a good summer.
You know, it's going to be good in a lot of respects, right? Because we'll see those car loans start to come down, HELOCs become a little bit more affordable because they're all tied to prime, and as they go up and down, so do those rates. Now, what is it going to do to mortgages? Mortgages are a little bit different because much like the stock market, everything's psychology and feelings, right? And who's going to buy or sell a certain thing. The trajectory right now is it kind of bumped down between October and January, stagnated a little bit. It's just been kind of holding steady right at that like 6.5 to 6.75 mark. I think most predictions at this point are thinking that it's going to continue to slowly come down, not quick. But the presidential election, in my opinion, could be like this black swan event, right? Depends on who wins. And it depends on where the economy is at that point. Also depends on if we get pulled into a war in the Middle East, right? All those things, crazy enough, they affect mortgage-backed securities.
Absolutely, they affect the world economy.
Yes, and we are a big part of it.
Yeah, and I guess the thing that, not that you're asking me for my prediction, but I
Please enlighten us.
I do think if rates go down, and I don't think we're going to, in relation to kind of my role in this with you, is like, I don't think we're going to see rates go down and then we're going to see this flood of inventory.
Yeah.
I think what's been nice and why, the spring market, even though we are in end of January, has already kicked off. Our spring market always kicks off in the winter season. It's almost like we have two markets, right? We have first half of the spring market's first half of the year, and the winter's the second half, and they're kind of very different. But I think what's helping this spring is that they've kind of seemed like they've stabilized since October. So we're talking 3 months that they've kind of hovered around 6.5, 6 3/4. I think that's helping. I think if they slowly, gradually go down, and even if they drop down to 6 and they just kind of hovered there, I think a lot of sellers who have been not wanting to sell, even though they have enough reason, right? People move for certain reasons. Their families are growing, their families shrinking because they're empty nesters, or they're having to move for work. But the people who have been holding back on that, even though the house is getting more crowded or the house is more empty and they just have a great rate, I think we'll see that. But I think we're going to have to see these folks, see everyone out there really trust that this is where it's at, that I'm not going to all of a sudden put my house on the market and then within a month or 2 months the rates dropped up or dropped down, and it's not so much can they not sell, they're going to sell, but then all of a sudden the rate drops up on them, they go into contract, and now they're worried like I'm stuck with an extra point because the rates were so volatile.
That volatility sure seems to have kind of stabilized. I agree with you there.
And I think if it kind of stays stable or slowly, gradually, I think we will see 2025 really kind of go gangbusters with more people ready to move, meaning more people ready to sell and more people ready to buy.
And hopefully that will finally kind of start evening that demand and supply issue that we have.
Some people say we are going to be in a low supply for quite some time.
I mean, real estate doesn't turn that issue around quickly.
No, we have a shortage of housing.
Yeah.
I mean, that's the bottom line. But what I'm really psyched about, 2025, we're going to get Jeremy a house. Hell yeah! Hey, thanks for listening. Hey, if you like what we're putting down on this channel, be sure to hit the subscribe button, hit the bell. You get notified every time. I'm Mark Buckner with the Mark Buckner Group. On this channel, I talk about living in Chicago, buying, selling, renting, investing, and maintaining your home. Stay tuned for more. Ben, thanks, brother.
Thanks, dude.
We're out.